So I'm really excited tonight to announce and introduce you to our two panelists. We have Effie Zahos and we also have Andrew Courtney. So Effie Zahos is editor-at-large CanStar and Channel 9 Today Show's finance expert, and also former editor of Money Magazine and UQ Alumnus. We're also thrilled to be joined by Andrew Courtney, who's the director of Plentitude Wealth and Plentitude Lend and UQ Alumnus. I'm going to hand over now to Effie, who's going to give a bit of an introduction about herself and also give you a bit of an introduction on some of the topics that we'll cover tonight. Thanks, Effie.
Hello, Tara. Thanks for having me back again. Hi, everybody. It's always a pleasure to be sitting in these webinars. Look, I thought I might start off with fear, guys. I don't mean to start off with fear, but it always grabs people's attention when you see the actual prices and how they're growing. It was interesting to see that about 87% of you said that you don't own a property and that you hoped in 1 to 5 years. So that means you're all cashed up out there, which I'm loving. I wanted to show this. I use CoreLogic data quite a lot. I mean, I use a lot of data, but if you can get onto their website and have a look at their data, it is very rich and it does really give you some great insights into what's happening with the property prices. I know the pain. I feel the pressure that first-term buyers are going through. I've got a 20-year-old and I've got a 15-year-old, and all they talk about is who's going to get the house, mum, and when you and dad die. So their clearly plan is basically an inheritance. I hate to say this. They also feel the pressure, and that they're actually regularly saving now at this age to jump into the property market. I do want to say one thing, and I won't go into too much detail now because I hope to hit some of those pressure points. Buying a property, yes, it's hard. It is hard, but it's not impossible. There are ways to jump into this market and do it sensibly. Just one thing to note there, with that Brisbane property price, $691,000. How do you feel if I told you this? That 12 months ago, you could have bought a house in Brisbane for $557,000. Because you've waited 12 months, it's actually cost you $365 per day. So each day you were out of the property market over the past 12 months, it was ticking up $365 per day. So you can talk about this whole fear of missing out and buyers jumping in and making irrational decisions, because that number you just think shivers, $365 each day. I can't save that fast. But like I said, I will be touching on some ways that you can look into buying property, whether that is, the government grants, whether that is 5% home loans, whether that is looking at LMIs and discounts that are available, whether that's, Bank of Mum and Dad, and there's nothing wrong with that. My first place was Bank of Mum and Dad. It probably helped that they couldn't speak English. So when the contracts came, I'm not quite sure what they were signing, but that's another story. We'll keep that. It all worked out well anyway. It all worked out well. So we'll look at a couple of options as to what can you do to get into this property market, because on average, it takes about 6 years to save this deposit, but then you're chasing your tail. And interest rates are at rock bottom price right now, but that doesn't matter because it's the deposit that's the hurdle. So I hope to cover some of those off. Andrew, over to you.
Hey guys, thanks for scaring the bejesus out of everyone. I'm happy. Well done. You've definitely done a good job there.
If you weren't awake, you're awake now.
yeah, that's it, exactly. Let me quickly share my screen. So I've been tasked to talk about within the wealth creation context, where does property fit into? So what I usually do is I run a webinar, right? So typical disclaimer, it's all general information, so please do not take this as personal advice, right? And this is the webinar that I run, right? And the 4 key property hacks that I cover off on this particular webinar is acquire fast and acquire more, right? Utilize lazy equity, superannuation and property, and amplify returns with your debt strategy. Now, obviously, I don't have time to go through all of this stuff within the next 5 minutes. So I figured I'd pick out the best 3 bits that you may want to consider when you're building your property portfolio, right? So the first thing is Archimedes Principle. I'm sure a few of you would have done a science degree or 2, potentially, right? Archimedes once said, give me a lever long enough and a fulcrum on which to place it, and I shall move the world. So how does this actually work within the context of property, right? So notice the asset with my squiggly yellow circle there. This is the fulcrum, right? Debt is the lever and the return on investment is the globe, right? So the fulcrum is what underpins this particular strategy, right? A lot of people tend to think all properties are created equal. So please do not see it that way, right? Because you need a robust asset that's producing a good rental yield, rental return, and solid growth potential, right? Not all properties are created equal. So make sure that the fulcrum, your asset, your underlying asset that you're utilizing, that you're acquiring and utilizing debt to acquire is robust, right? Now the debt, the length of the lever will determine how aggressive you are as an investor or as an initial property buyer, right? Obviously, the longer the lever, the more risk you're taking. Therefore, you must consider, well, what kind of loan to value ratio you may want to consider when acquiring your property. And the return on investment will be based off of the lever and the fulcrum, right? So I just wanted to kind of clarify that. And the beauty of investing in property and buying property is the fact that it's the only asset class with no margin calls. Now, I don't have enough time to go through what a margin call is, but one of the key things to consider here is to know the fact that it is safer to get debt in property with the right property than going down other asset classes because of the margin call risk, right? Something to consider there, right? Now, another thing that I like about property is the fact that you can manufacture value through renovations, right? Cosmetic or structural, right? Or you can develop it, right? If you buy property with development potential, right? You can land bank over the near future or the long term, and always, always, always look for highest and best use for your time and your capital within the property context. Now, what are the key things that you must consider when acquiring your property is buying ideally at median price or below. Now, obviously in the current market that we're in, it's really, really hot, very difficult to acquire property at or below median price. So you may want to go median or a little bit above because the market's moving so quickly. As Effie said, we're literally missing out on $365 per day. It's crazy, right? So you don't want to, and obviously you want to make sure that you buy at close to median price, to comparable properties out there. Far too many people are falling in love with the wrong properties and putting themselves in a pickle, right? Now, LeapFrog Strategy, this is the one that differentiates the solid property investors versus the novices out there, right? How do you do this? Well, you got to understand the implications of a cash out loan, manage cash flows, balance your borrowing capacity, right? And utilize LeapFrog Strategy, execute with precision. How do you do that? Well, ultimately, it's about utilizing lazy equity on a robust asset to begin with, right? Going again, and then some people will be happy with 2 or 3 properties in their portfolio, maybe 1 or 2, right? And others are going for shooting for the moon, right? And aiming for 7, 10, potentially even more. It's up to you, right? It's up to how ambitious you want to be in the context of your financial journey, right? So the equity position looks a little bit like this, right? That equity relationship, right? You must understand that there are a bunch of variables you must consider when building your property portfolio. So ideally, you want your property debt to be decreasing in time and your equity position increasing in time, right? Now, you've got a few levers to pull, and we may go over some of these levers in the near future, right? So protect your borrowing capacity. This is one of the key crucial elements to building wealth, right? You want to use that to your advantage and find the sweet spot. So what's the sweet spot in terms of the property play? You want it neutrally geared where it's not costing you that much, right? Ideally, if you can work with an 80% loan to value ratio or less, with the current rates at the moment, you can get a cash flow positive property and hold on to it for the long term, especially if you've got a tenant in there, right? Obviously different if you're getting in for the first time, right? But something to consider in the very, very near future, right? So a tale of 4 Aussies. The surviving Aussie will never get to the ideal income, right? The arriving Aussie are the ones who are saving. And what you must do is always have a surplus on a month-to-month basis and make sure you make that money work for you. And they will hit their ideal income, but it might take them a few more years, right? The striving Aussie will get there a little bit faster with a year saved because they start to invest and they come to webinars like this. So I congratulate you for coming to these kinds of things. Make sure you build up your tools in your toolbox to ensure that you can speed up the process of achieving your ideal income, right? And the thriving Aussie is racing towards their version or their ideal income. More years saved, if not 5, 10, 15, 20 years saved versus the most conservative way of doing it, which is literally putting cash in under your mattress. Not the best strategy to do, guys, right? So Taylor for Aussies, which graph depicts your financial situation? In an ideal world, you want to go from 1 to 2 to 3 to 4, basically. Speed up that process and get there sooner rather than later. If you're keen on hearing more about the webinar, feel free to scan this particular QR code, and I'll be going through those particular strategies at a much deeper length so that you guys can learn a hell of a lot more, right? Thanks very much.
Fantastic. Thank you so much, Andrew and Effie, for that great introduction. It's really set the scene for the rest of the webinar tonight, and I'm really excited for all of the questions that we're going to have. So to the audience, feel free to pop your questions. There's a Q&A box that you can put your questions in, or you can also just type them into the chat, and we'll be monitoring both of those. We've also had an overwhelming number of questions sent in advance, so we'll be doing a mix of the pre-questions and also the questions coming in on the night. So let's get started. So one of the most popular questions that we had come in was, what are some of the big mistakes that people often make when buying their first property, and how can they avoid it?
Effie, would you like to start on that, or do you want me to answer that?
I'll let you can jump in, Andrew. Go. You're
okay.
on.
Biggest mistakes? Well, look, I think the biggest mistake is rushing. Far too many people. I mean, I just had a client come on board looking at putting offers in without even getting finance sorted, without getting research done, without getting a conveyancer sorted or building in pest. The biggest problem a lot of homeowners or potential homeowners or soon-to-be homeowners face is the roller coaster ride of emotions that they go through when acquiring a property. Because you get that offer, suddenly it gets accepted, and hey presto, hey, fantastic, congratulations. You get that peak of emotional state, and then suddenly you realize, oh crap, I've got 14 days or 7 days sometimes to organize building in pest, get your finance sorted, all of that kind of jazz. So the biggest mistake that I find is that people go in too early without being prepared, right? So that's my answer.
Yeah, and Andrew, I probably agree with that. Buying a house can be very emotional, and I think my first purchase was probably emotional too. Very inexperienced buyer, and not having that checklist as to what I actually wanted. And it's okay for your first house not to be perfect. In fact, probably with these prices, it's not going to be perfect, and that's okay. It is also a stepping stone to where you want to go next. But it is doing that due diligence on what you are going to buy. And maybe your first place will be a unit, because when you look at the gaps, especially in Brisbane at the moment, look, in Sydney, that gap is tightening because the house affordability is way out there. People are moving into units, and then that drives up prices as well. But looking again at some of that core logic data, in Brisbane, that gap is still quite big between home and units. Very different kind of checklist if you're buying a unit versus a home. You want to go through all check the strata, what's been happening, what's wrong with the building, where's money being spent, what's the sinking fund. There's so much to have a look at and do your checks with that. Putting aside actual property, I also like to focus. I'm a journalist, so for disclosure, I'm not a financial advisor. I'm a journalist. Probably got about 30 years of information in this head, some of it useful, some of it useless. But, it's also important to get that loan right too, because you've got to remember that loan is amortized over 25, 30 years. So you might buy the property well, but if you don't do your finances well and stay on it, it's not something that's just a once-off. You really do need to review your loan situation once a year at least. But look, I get it. I see a lot of people go to whatever lender they'll give them a loan because they're desperate to jump into that. Sometimes that's okay if the property is right. But look, in the long run, you've got to make sure you've got the right deal there as well.
And Effie, how would you go about choosing a bank for that mortgage? Do you have any advice on that and what to consider?
My tips when it comes to choosing a loan, I mean, obviously you've got to work backwards. How much can you afford? But if you're into that situation now where you want to get finance, I always say this, everybody is a salesperson. No matter what, everybody's selling something. So the power needs to go back into your hands, and that's where research knowledge comes into it. There are so many sites that you can actually look at. I do also work for a comparison site, CanStar. You can go on there, put the filter to check everything that you want to see and have a look at all the loans if you want that way as well. I would research first and just see, look, who's the cheapest? I mean, I can tell you now, I did actually a story this morning on Today's Show with interest rates. By the way, they didn't move, of course. They weren't going to move. They're probably not going to move for a long time. I could get a home loan now for 1.77%. And Andrew mentioned before something called lending valuation ratio. The bigger that gap, that means what the value of the house is versus how much of a deposit you're going to put in. The bigger that deposit, the lower the rate. You need a 40% deposit to get that rate. So you may hear these great interest rates out there, 1.77. That sounds great, but you need a fat deposit for that. Other ones, can be fixed rates are pretty cheap too at the moment, 1.79, and that's only a 10% deposit. So I do my research first. I would then actually look at a mortgage broker. Mortgage brokers don't charge anything. They get a trailing commission based on what they refer you to. A good mortgage broker should have about 80% of the market. But I can tell you now, they're probably not going to have reduced home loans. That was the cheapest one. A lot of those non-bank lenders do not pay trailing commissions to mortgage brokers because they just can't afford it. They want direct business. So you're going to miss some of those. Some of them may have it. But because you've done your research, tick, you can say to your mortgage broker, why did you choose that one for me? Because I know this one's cheaper. And it may be, Effie, there's no way the lender's going to give it to you because you're self-employed, you don't have this and you don't have that. So there is merits in going to a mortgage broker as well because they know the lending policies, what they're lending, what they're not lending, and so on. And then at the end, the decision has to be yours based on knowledge. But yeah, there's nothing wrong by getting a mortgage broker so long as you have that knowledge to back it up.
Fantastic. Thanks for that, Effie. And on the topic of the deposits required, is a 20% house deposit still recommended or required? A lot of the audience sent this in as a pre-question.
They want to get in a bit faster, don't they? Like a 5% deposit maybe, or 2%. Do you know there used to be loans where you didn't have to put anything in, 105? Yeah, Andrew, you're not as old as me, but I'm sure you know about them. Look, there's a slide there. Then if you can just jump up, there's something called lender's mortgage insurance. So lender's mortgage insurance allows you, so going back to your first question, do you need a 20% deposit? No. Is it wise? Absolutely. Because you remember Andrew was also saying at the beginning that it is a safe investment. But if you don't have the equity and the price of properties reverse, you could actually owe more than what your house is worth. And that's known as negative equity. So what happens here to protect themselves? What lenders ask for is something called lender's mortgage insurance. Don't let the name fool you. It's got nothing to do with your mortgage insurance. It protects the lender. So even if you get into that situation and they sell you up and you owe money, the lender mortgage insurance will chase you for that. So it protects the lender because the lender says, hey, I will accept the risk here. I'm happy for you to put a 5% deposit. You can have a play around on Genworth. Genworth is one of the lender mortgage brokers, lender mortgage insurers. And I had to play around with here on a house worth $700,000. If you only put a $35,000 deposit, which is 5%, your lender's mortgage insurance is $27,946. It's not cheap. Okay, you can argue that I just told you these prices are going up $300 odd per day, so you're chasing your tails. But you have to make a very educated guess here where the property market is going. Is it going to continue this trajectory? Can you afford to pay that LMI? Capitalize on the loan? Will you come out in front by jumping in, or are you better waiting off and saving? They're the sums you have to do, and there's calculators online to help you with that as well to make a decision. But you are doing a bit of crystal ball gazing here. So obviously lender's mortgage insurance is one way to jump in. I mean, Andrew, if you want to jump in with others, because I can just keep shooting different ways you can jump in.
Yeah, look, absolutely. And obviously the big one is the parent's bank account. Yeah. Back to what I was alluding to earlier, like you can actually get in for as little as stamp duty cost or even less if you buy sub 500K here in Brisbane and Queensland, right? So I mean, some people can actually acquire a property for as little as about $2,000 or $3,000 down, right? Now, how do you do that? Well, you need a parent's guarantee, right? And you're essentially borrowing 100% of that property, right? So some people are buying up to $700,000 and paying that 24 or 30-ish $1,000 stamp duty cost. No lender's mortgage insurance. So that's a really, really big one that you may want to consider if you're lucky enough to have parents who can help you out, basically. Now, if you don't, well, guess what? You're going to have to do it on your own. And you may want to cop the LMI, especially if you know how to do the research and you're buying a robust property. That's the key, right? Because you certainly don't want to be stuck in negative equity, like a lot of people buying in Gladstone, for example, 6 or 7 years ago, and now they're stuck with negative $100,000 or $200,000 of equity because they bought a lemon property, right? So very, very important to make sure that you do the right research and put yourself in the put yourself in the best position to win the property game. Yep.
I hope my kids are not listening, Andrew. There's no way I'm going to give them a guarantee. But I do have a slide, Nina, on that. I just want to show you what parents are giving. If you can flick that graphic up by Digital Finance Analytics, here's something to go home to tonight to your parents and say, hey, Mum, Dad, do you know the average amount that parents give is that 86,000 there? Yeah, $89,637. Can you believe that? That was taken out in March. But back to what Andrew was saying, I think the next slide I've got there, these are definitely some pros and cons to look out for. And on a serious note, you are putting your parents in a bit of a situation because it is going to affect their financial kind of journey as well. It may prevent them from getting new loans. They are liable for it. Of course, they'll guarantee the loan. They'll limit the guarantee. But as Andrew was saying, it does get you in quite earlier. I would suggest if you go down that path, do take out insurance, even yourself. You might think, why do I need insurance? Because if something happened to you, God forbid, that puts you in a situation where you are permanently unable to work for whatever reason, your parents will then have to jump in and start making those repayments. So you need to protect yourself, and yourself being the asset, the biggest asset, you being able to generate an income. So make sure you ticked all the boxes there if you are asking mum and dad to come in. But sorry, Andrew.
Just to clarify, that's income protection insurance, guys. Like if you can get that, that'd be fantastic for you because it gives your parents peace of mind. And just a little tidbit there, home is at risk. And Effie did mention it's a limited guarantee. So the home is not at risk. It's the amount that they guarantee, right? Mm-hmm. Now, quick strategy for you guys who may want to consider this particular tactic to talk to your parents about. Now, how I structure this for my clients is this. We go with a 3-pronged attack for our parents.
Oh, this is terrifying.
Well, Effie, this is about de-risking everything and getting the parents out within a 2 to 3 year period. Let me break it down for you, right? So first and foremost, you have to have a budget or a cash flow management system in place, right? You have to prove to your parents that you're capable of saving thousands of dollars, if not tens of thousands of dollars per year. Once you got that one down pat, then you say, Mom and Dad, would you be open to this particular idea? How I'm going to lower your risk for you, because the game is this. You're going from 100% loan to value ratio to 80% loan to value ratio so that you can kick them off as guarantors, right? So what you're trying to do is minimize the time associated with the guarantee by doing 3 proactive things. What are the 3 proactive things? Well, the first one is to pay the debt down faster, right? So you've already saved thousands of dollars per year. You're capable of doing that. Well, guess what? You can tell your parents, look, the 20% loan, let's say you're buying a $700,000 property. The 20% part of the loan is the guaranteed part, right? So what you'll say to your parents is this: I will happily pay 3 or 4x the minimum repayments on the 20% part to speed up the process. So that's one thing. The next thing is you're going to know how to do your research properly, and you're going to know what the median price is, where the market's moving towards, and you're going to share with them what are the key drivers of property growth in the future so that they understand the research and how you filtered down to the right property, right? So you need the framework associated with that. And the third and final one, which is the most powerful one, is if you buy something that needs a little bit of TLC, but it's got good bones, right? you can put in a bit of elbow grease in that thing, right? And potentially do a small renovation. What does that look like? Quick lick of paint, right? Landscaping, new floors. You can get that done within $10,000 to $15,000 budget, right? Suddenly, you're in the position where you're kicking your parents off within a 1, 2, or 3 year period. If all goes well, you're done in a 1 or 2 year period because A, you paid down the loan a hell of a lot faster. B, you've done a small renovation, and C, they understand how you've done the research and they have confidence in your particular strategy. This is the way we help our clients get the limited guarantee across the line. Effie, how does that sound?
When my kids say it, and I'd want all that in writing too. Thank you very much. There are a couple of other ways too you can get if you are wanting to avoid this lender's mortgage insurance. So we just spoke about the bank of mum and dad. There are lenders now, the market's so competitive, and what they're actually doing, which I haven't seen done for a long time or as many jumping in, lenders actually reducing LMI, eliminating completely based on occupation. So hopefully I've got a graphic up as well, Nina. There's quite a lot of text on it. If you can flick that up, to do with lenders mortgage insurance and what some lenders are actually offering out there. So look, I guess while Nana's getting that up, the thing to watch here, there's a lot of text here, but let me break it down. These are just some of the offers out there. So basically St. George, which is all the subsidiaries there as well, they're offering a $1 lender's mortgage insurance for first home buyers with LVRs of up to 85. So that's not the full, 90 or 95, still a lot less, but it's $1. You've got others, have a look, like, UBank, $0. You've got others that give a $5,000 grant. This is just what's happening now. They change every month. The new deals come out. My only tip here would be, this is all very well and good, and you can avoid quite a big hefty amount of lender's mortgage insurance here, but make sure the interest rate with these home loans are good as well. You want to make sure you're getting, at the end of the day, what you're buying is a financial product. It's got to stack up on its own merits and forget really the bells and whistles. Or if you are, factor that value in. What am I saving by doing this? What am I paying? What's the net benefit? So take real care here. You've got other lenders like too, ANZ, through their mortgage brokering. I'm sure there's probably a few doctors, chiropractors, physiotherapists. It tends to be in the medical field. They are waiving LMI on certain occupations completely. So that's another way to maybe look at it. And then, of course, the government does have those two schemes out at the moment. The first home loan deposit scheme, 5% deposit is all you need, and there is no LMI. There are some restrictions there. And off the top of my head, I think the income is 200,000 for a couple, a single 125. You can't earn more than that. Just triple check that on the side. There are price caps. So you might have your heart set on a nice inner city terrace there in Brisbane, but you may not be able to get it because it exceeds the price cap. So you have to look at that. The other one is a 2% deposit only, and the government picks up the LMI tab. But again, there are restrictions and price caps, and that's if you've got a dependent child, that you would be eligible for that one as well. So the other thing to note for there is that not all lenders offer these, are attached to the scheme. So again, have a look at what interest rates are these lenders that are offering the scheme. What are they sitting at compared to, what would be the cheapest in the market that you could possibly get? Thanks, Nina.
You may want to consider as well is cash bonuses. There's a bunch of banks out there that'll provide you $2,000 to $4,000 worth of cash bonus, right? If you were to do the finance with them, right? So that's a nice little bonus for people who are trying to save more. Now, obviously, the rates have to stack up. They have to be the best rates available to do that. And there's typically around 6 that's always available when it comes to the cash bonuses. So what you do is you just cherry pick the best ones, right, and make sure that you run with something that you're comfortable with.
Yeah.
Right?
I think at the end of the day, just to sum up this whole 20% deposit, obviously the more equity you have in there, the better. But I do understand the market is moving fast. Where is it going to go? Look, I'm no crystal ball gazer. You know, anyone that says that knows where the property market is going is, well, hats off to them, because we didn't think it was going to be even this way. You know, it's probably the, you know, pandemic proof property. It's the only asset class that has just continued to head up north and not stop. It has slowed down a bit. I mean, looking at CoreLogic's values now, they rose about 1.5 in August, nowhere near the height in March of 2.8. You see what the big banks are projecting. Yes, a nice big year ending, 20% maybe returns here. Next year is expected to slow down. I would take all that noise away and just focus on yourself. What's your deposit? Where do you want to buy? Have you ticked off those things that Andrew was talking about? Can you afford it? For me, I don't like to time anything when it comes to investments. I like to jump in when I can and when I think it's right, rather than timing the market, because you are playing with danger there. It's a long-term asset. You're not going to flip this tomorrow. Buy well, and, you know, if you don't have to sell when it's bad times, in the long term, you will do well. So try not to let all this noise confuse you. There are ways to jump in fast if you don't have that full deposit. We've explained some of those. Go into them, because some of them can work in your favor. If you buy well and the market is rising, you can beat it, but take care.
I'm a big fan of, just to add to the deposit play, I'm a big fan of the First Home Super Saver scheme as well. Right? So you could do this over a 4 financial year period if you're trying to save for as much as you can to aim for that 20% deposit, or you can straddle it over 2 financial years, right? So we're now in September. You can put in $15,000 this particular financial year and another $15,000 in the next financial year, and then withdraw once. Now, this is the key rule. You have to withdraw once only, and then buy within a 1-year period and get an extension for another year if need be, right? So very, very important. You're bound to save, especially as a couple, you're bound to save $4,500 up to $9,000 depending on how you structure it, right? There's a 15% tax saving by utilizing that scheme. That's one of the best schemes as far as I'm concerned.
Yeah. And I think that's a good point that Andrew raised. I mean, this deposit, how can you save? I mean, putting money in the bank is definitely, you might as well just throw it out the window personally. You're not going to earn anything in the bank. It'll go backwards. So you're trying to find somewhere where it could give a good return, but let's be real here. You want this money to be safe too. So cash is very important. You're going to have to play the game and find some online savers. About 1.35 is what you'd be lucky to get around there. But as Andrew said, you know, your First Home Super Saver scheme, the most tax effective way. And I think, Andrew, is that going to 50,000 next year?
Yeah, it goes up to 50. Yep.
You've got that. And I like to think of them as buckets. You've got your online saver, which is cash. It's guaranteed. It's going to be there. You've got the First Home Super Saver that Andrew spoke about, and then maybe go see a financial advisor and look at possibly exchange traded funds, or, you know, investing in the asset class you want to buy. Because then if it goes up, your deposit goes up. If it goes down, it goes down too. But that's what a good financial advisor can help you set up, these buckets to help speed your deposit process along, if you've got the appetite for that risk and the time, of course.
Absolutely.
Fantastic. Thanks for that. So I think we've covered the financial aspects. So if we look now towards what and where should people look at buying, do you firstly have any tips around looking for a property with more value and growth potential? And also following that, we've got a question here about what impact do you expect the Olympics to have on the Brisbane property market?
I think Effie prepared something special for all of us. Just
with the Olympics.
Assuming Sydney, don't forget, Sydney and Melbourne, guys, is a leading indicator, which means they typically outperform before Brisbane, right? So if that assumption is correct, well, we've got an exciting time ahead of us post Olympics, right? So have a look at this.
Well, this is, CoreLogic, again, I just use their data. I had this as a segment for today's show, so I didn't prep too much, unfortunately. But look, I'm interested in the Brisbane market. I'm a Gold Coast girl myself. I had property in Brisbane. And look, Brisbane was doing quite well besides this Olympics anyway. I mean, there has been net migration to Brisbane has been absolutely crazy since the pandemic. It seems everybody wants to come up there and live, move out of Melbourne, move out of Sydney. We're all coming up to Brizzy. And I speak to a few property experts as well. There's a great Terry Ryder who has Hotspotting up in Brisbane, has also wrote something in my newsletters around the Brisbane property market. The graph that you see in there, basically what the CoreLogic has pulled out, they wanted to show what happened to the Sydney property market when the Sydney Olympic Games were announced. So when they were announced in 1993, you can see there the white bar graph there. Property is just under 190,000. And then when they were held in September 2000, it jumped up to 302. So Sydney dwelling prices actually increased around 60%. Almost twice the growth recorded against the other capital cities. It then went down quite a bit, and compared to the other capital cities, didn't move as fast. But then how much of that has got to do with what was happening at the time? The Sydney market was booming. Interest rates as well. It's hard to separate the two, but there's no doubt about it. You pour a whole lot of money into one particular area, the infrastructure that it's building, and then you can see that announcement, since it was announced, that price was bubbling along and factoring into it well before the games came. And I guess for what a lot of property commentators are now saying with Brisbane, there's a lot of potential. There's a lot of great, exciting opportunities. And I did ask the question, naturally, I was curious to see, well, what areas should do well in Brisbane if if they've got the Olympic Games. So Nina, that next slide there, basically, I mean, they can't pick properties. These are just potential growth suburbs. This is not to say definitely go in there, grab yourself a property and you do well. That would be crazy and irresponsible. But it would be a good starting point. I mean, obviously, anywhere where the stadium is, around those areas. They also pointed out Sunshine Coast, Gold Coast as possible areas, but these are quite close to the location of the games, and just because their medium house prices still quite affordable and potential there. So if you are looking, I would definitely research further into those property markets and just see for yourself. But pretty much so, once the games is announced, a lot of that pricing is already kind of factoring into it, and people are looking for opportunities. So if anything, you guys have got a very exciting time between now and the Olympic Games, which is 11 years or something away. Yeah.
Absolutely, and don't forget the Moreton Bay area as well. The price points aren't as high as Brisbane, so you may want to consider Moreton Bay, because there's a university being built over there, a new hospital, a lot of infrastructure being invested in, and it's a bit of a hotspot around that Strathpine region in suburbs around that. So you may want to consider having a look through there if you're capable of living an hour or so away from the city, if you're working in the city. Hopefully, with the silver lining of COVID, with Zoom being available from home, and you can work from home with your different kind of workplaces, it may be doable, right, to live a little bit further out and capitalize on upside potential around that area too.
Fantastic. So we still have time for a few more questions, but before we take the final questions, Nina, can you just pop up a couple of slides that we have? So obviously, we've been very lucky to be joined by Effie and Andrew today, and they've provided some valuable advice. So if you want to stay up to date with Effie and follow her, you can check out her new book, Ditch Debt and Get Rich. And you can also register for Effie's free newsletter, Money Mondays, or follow her there with her Effie Zahos handle. And if you want to stay up to date with Andrew and everything he's working on, and that webinar that he mentioned at the start, you can scan the QR code here to go to his website and find out more about the Winning Property Portfolios webinar.
So follow me on Instagram and smash the like button on YouTube, please. And subscribe.
Fantastic. Thanks for that, Andrew. We also will have one more Get Finance Fit series in November on financial goal setting for 2022. So if you want to register for that event, you can just scan the QR code there. Otherwise, you can head to the UQ Alumni website and you'll be able to register for it there as well. And then finally, on the topic of UQ Young Alumni events, we have our next event, which is part of the Employability series, which is an entrepreneurship workshop that we're going to be holding on Tuesday, the 12th of October in UQ Brisbane City. There'll be more details to come, so stay tuned on our Facebook page, and also make sure you're checking your emails from the UQ Young Alumni. Fantastic. So we've got about 10 minutes left, so we'll probably take one or two more questions. So one of the next questions that's come through is around what are some of the hidden costs associated with buying a property?
Sure. Hidden costs. Look, I think the number one hidden cost that a lot of people don't realize is the fact that you have to spend around 100 to 200 hours to actually acquire the right property, right? So that's the cost that never gets talked about. Other costs that you have to consider is obviously stamp duty, right? A lot of people save up for a deposit and then they realize, oh crap, you've got to come up with stamp duty, which could be up to $24,000, $36,000, $48,000, right? So it's typically a good rule of thumb is around that 3% mark, right? You've got your conveyancing cost, which is typically around $800 to $1,300, right? And your building and pest cost, which is around $400 to $550, $600-ish, right? So those are the main costs. But the biggest cost that sneaks up on you is the time and the emotional fortitude that you build up, hopefully, if you acquire one, or the depression that you get if you keep losing out on these particular properties, unfortunately. So that's my take on that. Effie, anything to add on that one?
No, I think you got most of the costs. As a first-time buyer, of course, you could be eligible for concessions and grants, and for even first-time. I think in Brisbane, correct me if I'm wrong, is it 15,000 first-time buyers can get for properties that are new under 750,000. So just have a look and see what stamp duty concessions you may get, or as a first-time buyer, they tend to attach them to new properties, depending on the state or territory, what you may be able to be eligible there as well.
Just to kind of chime in on that point, no, I'm not very popular within the property space because of this. I'm not a big fan of buying new, purely because back to that median price, right? Like a lot of the new properties, the majority of them are priced at the highest outlier position of that particular distribution, right? Now, what that means is that the median has to catch up to that, right? And that typically equates to approximately 7 to 10 years, right? A lot of people who buy new are stuck with the value that they buy it for over the next 5 to 10 years, unfortunately, right? So if you're buying new, just keep that in mind, right? And you got to ask yourself, well, is it a lifestyle decision, or is it an investment decision, or is it both, right? It's always a balancing act between lifestyle and investment for these capital, decisions that you make.
Yeah. Andrew, I just noticed Darren sent an interesting question that went on to what you were talking about with additional costs. One thing that we didn't mention, and it's a very good question, Darren, is there a tool that projects climate change risk, for example, coastal windfire prone properties? You raise a really good point, because what we do forget is the ongoing costs of protecting our homes, and insurance costs, because of that very question that you've asked, have actually gone through the roof. I mean, it's almost virtually impossible to get an insurance policy that's affordable, especially in southeast Queensland or further up north, because cyclone areas and so on. I myself actually live in a bush-prone fire zone area, and my insurance premiums are quite expensive. So it is actually worthwhile understanding where you're buying, what zone is it in, because those ongoing insurance costs, and things are only going to get worse with climate change, can have a real big impact on your household expenses. So yeah, good question, Darren.
Absolutely. And where you find that data, as Effie mentioned, is the zoning maps on your council website, right? So if you go to Brisbane City Council or Ipswich or Logan or Moreton Bay, they all have their websites, right? Look for planning and development online, PD online for short, right? And then if you click on that, you'll click through a few times, and then suddenly you've got a map of that particular government area, right? And then you can start looking at zoning. You could look at flood overlays. You could look bushfire zone overlays, right? And then you can start really kind of pinpointing the right property for you, because if there is a risk, it will be flagged especially by the valuer, right? This is a stakeholder that we haven't really talked about, but the valuers play a key role in the finance side of things, right? So you must know these things as well. Yep.
Fantastic. And on the topic of looking for the right property and all these considerations, probably one of the most popular questions that got sent through was around, is it better to buy sooner on a smaller budget in an area that might not see as much as large growth, or wait until you can afford a more expensive property in a historically faster growing area such as inner city?
Look, back to what Effie mentioned earlier, get in when you can, right? And really, you have to, as a household, you must work out, well, is it going to be a lifestyle choice or an investment choice, right? Some people will be ready today to acquire an investment property, but are hoping to acquire their first home in a nicer area that they want to kind of move into and have a forever home sooner rather than later, right? So you've got to kind of weigh out, well, what are you trying to achieve? Right? Are you trying to speed up wealth creation, or are you trying to get comfortable first and then build your career, speed that side of things up, and then invest a little bit later? So you've got to weigh it all out and make sure you do what's right for your situation. Now, the biggest problem that I see out there is that everyone's coming at you from their perspective and they're providing you with good intentioned advice. But the fact of the matter is, they typically tell you the playbook, they show you the playbook that they've done. Right, so you got to ask yourself, well, what's the playbook that you want to utilize, and what's point B? And this is a good segue into the next webinar that we'll be running, which will be goal setting, and how do you go about doing that later on in the year, right? Because that will determine, well, what's the next best step for you? Because far too many people are dogmatic in their approach, but ultimately you get to decide what you're trying to achieve and what the best steps are for your situation. Hopefully that's answered your question.
That was good. I was just going to say, how long can you stand living with your mum and dad still to save up? No. Can you stay longer and save some more, or do you have to get out? No, I thought you answered that spot on, Andrew.
Andrew, talking about receiving advice, what are your thoughts on buyer's agents?
Look, I think I answered this on one of the Q&As earlier. I think it's definitely worth it if you don't have the time, right? Now, I'm a big believer in teaching a person to fish rather than feeding them a fish, right? Because it's a skill set to acquire a property. Now, the biggest problem that the majority of people have is that they go through this emotional roller coaster ride when they're acquiring their properties, their first or their second property, that they never want to do it again because the real estate agents typically don't just tell you a bunch of lies, and they're playing a game with you, and you feel that they can't be trusted, right? So what happens is you go through that emotional roller coaster, and then you say, I'm never, ever, ever going to do that again, right? So to be honest, I've just forgotten what was the question again? Sorry, guys.
Buyer's agents.
Buyer's agent. Oh, yes. So basically, if you don't have that emotional roller coaster ride, and if you learn how to do it, well, you don't particularly need a buyer's agent. But if you're in a career that is very, very demanding and you don't have the time, back to what I mentioned earlier, you can spend up to 200 to 300 hours of your time to acquire that property, right? So you got to ask yourself, well, there's a return on investment on your time, right? And if you can do it better through a buyer's agent, absolutely you should go for it. But there's a cost, right? Some buyer's agents charge $15,000, others charge 2.5%, 3% of the property price. So it can be quite a hefty invoice that you have to pay. So you got to kind of weigh it out. Cost benefit analysis, right, is the key.
I've actually had people that use a buyer's agent the other way around when they've got the property, something to think about later on, and they want to sell it without paying an actual real estate commission. And it works for unique homes because obviously buyer's agents are looking for something particular for their client. So the idea is you go to a buyer's agent and you say, hey, I've got this place here at, I don't know, Hamilton, and it's this. I'd love it on your books. If you can find a buyer, then great, and there's no commission there. So it's an interesting way that they're avoiding the commission on a sale of a property.
Yeah, absolutely.
Fantastic. So conscious of the time, we might start to wrap up. Effie and Andrew, do you have any final thoughts or advice that you want to give the audience, or final tips around buying your first property?
For me, it's that old saying, don't feel so pressured that you are missing out. There's so many milestones that you want to hit, and this is a big one, and it's a good one to hit. I'm a big believer of owning property, and in some cases, you know, it may not even make sense on paper why we've got this mortgage for so long. I mean, that's another story. You've got to get rid of that mortgage fast. But what I like about property is it's forced savings. A lot of us actually only save when it's forced upon us. And what I mean by force, you will pay back your loan. You know that, oh, gee, the mortgage, I've got to pay it, I pay it. And that builds us wealth. And that over time is gold. And that's what I see the family home as a way of forced savings, and that will create your wealth. And it is going to then be the building block for your next creation, you know, maybe draw some equity after that, buy something else or invest in somewhere else. I like it because of forced savings. Do not get too scared about when to jump in. Just do it right. Do your due diligence, buy right. And like I said, if you buy a good quality asset, hold it over the long term, and you don't have to sell it for whatever reason because you're forced to sell it, you should do okay.
Absolutely. Totally agree with you there, Effie. Look, one of the key things that everyone should be considering is having a framework to stick to when buying a property. You need to understand how to do your research. You need to get your finance and your borrowing capacity in the right space, right? And then you need to understand, well, what kind of strategy are you looking to utilize? Is it going to be a stepping stone home? Is it going to be a forever home? Is it going to be investment property? You may want to rent vest. We didn't cover that off. I mean, we covered that off in previous webinars before. You may want to rent vest to begin with, right? It all depends on what your goals are and what you're trying to achieve. And then you got to negotiate hard, right? And these are the things that I cover off on that particular webinar, right? Where I can show you a bit of a framework to ensure that you minimize the risk. Because the key is, if you minimize that risk, you're going to have a smooth run at increasing your equity position and getting a cash flow positive property if you decide to move out and buy another one, right? Because that's a great strategy. A lot of people make a mistake of buying and then selling and upgrading, right? If you can manage to utilize it, balance your cash flows where you can utilize some equity from this one to buy another one, right? And go again. And whilst this property, the initial properties are growing for you, it's amazing how much wealth you can create because of the leveraged side of that portfolio, right? If you combine the property play with the share portfolio, you can dollar cost averaging, it's amazing what you can do. I'm talking hundreds of thousands, if not millions of dollars over a 15-year period if you do it right, right? So the key thing, if to just wrap this up in a nice little kind of pretty box, you need to make sure that you prepare, right? Don't go in there because you see old mate down the road or your peer buy one. You may not have seen how much work they have done to actually acquire one, right? You need to put in the work, make sure you're confident, because confidence only comes from knowledge, right? You've got to put in the work to get that knowledge and get that confidence, and then off you go. You can work with the right professionals or do it yourself, right? And make it happen for you, right? So please don't rush it, as Effie said. And if you do rush it, make sure you do the work so that you're confident. Because the last thing you want to do is sign on the dotted line and hope you've done the right thing, right? Hoping is a fool's game in the property space, because you could be making a $500,000, $700,000 mistake. I don't know about you. I certainly don't want to be doing that, making that kind of mistake, right?
I think that's a great summary. Thank you so much, Andrew and Effie, for wrapping that up. And thank you again for sharing all of your knowledge with us in the past hour. It's been incredibly valuable, and I'm sure the audience has got a lot out of it.